The amount
Yes.
raised from issuing the shares is 38,400. That's the amount that they raised from this rights issue. So what we are saying is, what we go to ordinary share will be 25 out of the 60, while the remaining 35 will go to share premium. So like I was saying, you can, instead of doing this as 25 divided by 60 times 38,400, you could have done 25 cents or 25 cents multiplied by 64,000 shares, because that's the rights, that's the amount of rights shares. And then you could have done 35 cents multiplied by that 64,000 again. You would have still gotten this.
64,000. Okay, that is shorter. Thank you.
So if that makes more sense, or if that's more comfortable for you, then you can still do it that way. You still get exactly the value.
Thank you.
Okay, please let's pause and allow these people to join us, and then we continue. Cyril, if you start recording, please pause. All right, so we're done with our rights issue. So we move on. So we continue from our question. So that's the right. So we go and continue down. So we've done ordinary share and share premium until we see the other information. So they give us retained earnings now, right?
Yep.
So we're almost done. Really, we're at the end now. So retained earnings at the beginning of the year is how much?
2608.
So 26,080, right?
Yes.
Yes.
Yeah. So we have our convertible loan, 5% convertible loan note. Where we have 32. So the question says, at the beginning of the year, that's 1st April 2013, XTOL issued a 5% 50 million convertible loan note at par. Interest is paid annually in arrears on 31st March each year. The loan note is redeemable at par or convertible into equity shares at the option of the loan note holder on 31st March 2016. So that's how many years from that's the only important thing, the redemption date. The redemption date is now how many years? 3 years, Abi? So we have from 1st April 2013, so 2014, 1 year, 2015, and then 2016, 3 years, Abi?
Yes.
Okay, then the interest on an equivalent loan without a conversion right would be 8% per annum. And then they've given us information for both 5% and 8%, 5% being the face value, the nominal value, the nominal rate, and 8% being the effective rate. Like I always tell people, when you're looking at this kind of question, you will have the lower rate. The lower rate is your nominal rate, while the higher rate is your effective rate. All the discount factors that they give you under your nominal rate, strike all of them out. They're just a distraction. There's nothing you need the nominal rate for. There's nothing you need those values, those discount factors under the nominal rate for. They just give it in the exam. It's completely irrelevant. You can strike those things out with a biro if you saw it and you don't do paper-based again. So just strike it out in your mind. You will not use it for anything. So the way to go about this convertible bond is just a process, and the process is quite similar. So the thing is actually easy once you understand how to do it, and very, very interesting, and usually gives about 4 or 5 marks for that working, especially when it's a full one. And I think this one is a full one. So quite just to understand what you're doing and the steps involved in the process. So let's practice something I think I heard you say you are done before. So we can call that a
Hello.
financial instrument or a convertible bond.
We didn't really do it though. We just
But
started.
you are the only one that said we did it. Yeah, I didn't say.
Okay, let me ask you the question now. Did you do the calculation of it? Whether you
No.
understood it or not is not important.
No,
Did you do the calculation?
we didn't do the calculation.
If
Though.
you didn't do the calculation, you do it now.
I don't know because I didn't go inside. Don't even know contractual cash.
Okay, let's just do the question. Let's see the confusion. So look at the questions of financial instruments and then go to the integration. We got the bond holder that bond holder that bond, so I don't like it or somebody like the bond holder to take shares. So those are the two. Now IAS 32 requires that once a company issues convertible bonds, whether or not it is likely that the bondholders will collect cash or collect shares, there is an accounting treatment for it. There's a way IAS 32 prescribes that we recognize convertible bonds. And it is quite simple. The first thing is you will recognize a liability. Now the liability will be at present value. And then every year over the life of the bond, we would unwind that bond to its face value. So the present value of the liability will be less than the face value of that liability. So in this case now, some of the things that, let me say some things, and once you do the calculation, if you look at this again and you look at it, then you start understanding it gradually until you really get perfection in understanding. So the face value of the bond, in this case, is 50 million. We'll compute the present value of the liability, and then after getting the present value of the liability, we'll get what we call the equity option. The equity option will be the difference between, are you hearing me?
Yes.
Yes.
Okay, so the equity option will be the difference between the face value of the bond and the present value of the liability. The liability, of course, will be non-current if it is more than a year before it will be redeemed, more than a year after the year end. So most of the time you will see that we'll take it for granted and the liability will be a non-current liability. There's no separation like how we had in leases. So it will be a non-current liability. The only thing is this leases. So today, like I always say, you're doing another very, very huge part of your syllabus. The computation of a convertible bond is quite important. So let me just start. Now, what we do is, there are some things I've emphasized, and those things should be in your note. The nominal rate is usually the lower rate. It's always the lower rate, and the effective rate is the higher rate. And then we'll draw a table for this. So there's a process to this. First of all, we want to do our cash flows. So we have so we start with our interest now. So we can do nominal rate, and let me try and be as explicit as possible. So nominal rate is equal to 5%. Your effective rate is equal to 8%. That effective rate doesn't come into, is okay, it will do something for you. Now the first thing to do is the cash flows. The cash flows over the life of the bond are the interest payments, the annual interest. Let me call that annual interest instead. So are the annual interests and the principal repayment So those are the cash flows. Now, the annual interest would be based on the nominal rate but discounted using the effective rate. Okay, so that's all. Now, the discounted cash flows would give, oh, I'm just typing. So the discounted cash flows would give the present value. So present value PV after today. So present value PV, something we've seen before, of the non-current liability in or at the initiation, at the commencement of the bond term. Now, other things to remember. Now, this, please note, this present value, this thing is supposed to be your note. This is supposed to be what you're supposed to know before you start doing this thing, or what you should have done. And I'll be surprised, if I pick your note, I'll be surprised that I'm not seeing something that reflects what I'm writing. So this present value would be unwound. So this is like what you've done, what you should have done with provisions. So the unwinding of the discount, right? You don't answer me.
Would I hear you?
You did hear me, Abi?
I'm listening.
I'm following up now. Remember you said that it will be best for us to be listening and be seeing how you're computing than
Yes,
copying.
I say you should not
listening.
write. I did not say you should not talk. Writing might distract you, but talking is not distracting. When I say something you've seen in IS 37 provisions and you keep quiet, have you seen it or you've not seen it?
We've seen it.
Thank you, Ella. I know you don't used to lie. People now, they will swear. They will swear that I swear to God, if I've seen this thing, let moon fall on my head and kill me. You know, no sin has scam. Like if moon can just fall like that. Okay, so the present value would be unwound over.
You
said what?
Ella is spoiling the show for us.
Over the life of the bond. Continue. So this present value will be unwound over the life of the bond to get to, okay, unwound over the life of the bond. Any other thing I talk, it will be better to show you what I'm saying. Then the final thing is the equity option as a result of a compound financial instrument is equal to the face value of the bond minus the present value of the liability in year 0. So at the initiation. Now all these things I've written, I've tried to summarize it, but it's quite detailed. Now all these things I've written. Now let's come and practice it. Now let me show you how this works now. And like I think you said, you had seen something like this before, see another one. But please follow me, try and make sure you get this thing. This thing is quite simple if you understand it. And it is so gratifying, it's so rewarding once you understand it. Because first of all, if it is giving you 4 or 5 marks in the exam, and you can get that 4 over 4 or 5 over 5, you've almost passed the exam now. If you get 4 over 4, it's remaining only 46. Okay, so we move now. First of all, we'll calculate our interest. So annual interest from this question now. Annual interest is equal to 5%, right? So the nominal rate times face value. So that's equal to 5% of how much?
5% times 50.
Times 50,000, Abi?
Yes, times 50.
Okay. So that's equal to 5% multiplied by 50, 1, 2, 3. So that's 25. Now, so our cash flows, so the cash flows would be 2,500 per year for 3 years, and the 50,000 face value, or the 50,000 face value, that's the principal repayment. Okay, let me say that. And the principal repayment of 50,000 in the final year. So now the way to do this thing is just come and set it up. So you have your year. So we'll have year. We have our cash flow. So cash flow. Then we have our discount factor at what? Our discount factor will be at what rate? The nominal rate or the effective rate?
Effective rate.
The effective rate.
All right, thank you. So the effective rate, so at 8%, as the effective rate. And from there, you get your present value. So we can get our PV, our present value. So our present value will be equal to the cash flow multiplied by the discount factor. Okay, so we can come and do our work now. So we have our year. We have year 1, year 2, and year 3. So what I've been trying to explain to you, this is where I needed you to be able to follow. If not, it starts looking like Greek. So the first year, you have 2,500. The second year, you have another 2,500. That's your annual cash flow. In the final year, you have 50,000 plus 2,500. Because in the final year, you have both interest and principal. Do you get that? So if you see 52,500 somewhere, it doesn't make any sense. That's why I've given you all the story I've given you so that you can appreciate what's going to happen. So our final year would have both the interest for that year and the principal repayment. Do you get that?
Yes.
Okay. All right. So we now have our discount factors. They've given us the discount factors. If not, we would have calculated it. It's quite simple to calculate. But they've given us in the question. So we'll just come and put. So what are our discount factors? So the first one, 0.93. Second one,
0.86.
0.86. And for 8%, year 3, 0.79. 0.79. So now our present value will now be equal to the cash flow multiplied by the discount rate. So that value, and I expect that I can drag it for all of them and it should give me the values for all of them. So it does that nicely. So therefore, so I can come and say, therefore, the present value of the non-current liability, or we'll just call it liability, at year 0, will be equal to the summation of all those cash flows. So the summation of the present values rather. So that will be our summation of present value. So will be our summation of present values, which is, so is equal to the sum of all these figures, the 3 of them for those 3 years. So if it's 5 years, then into the summation. So if it was 5 years, then you have 25, 25, 25, 25, and in the final year, 52,500. So that's our, and that figure now, this figure here is our non-current liability in year 0. But remember, we're not preparing for year 0. We're preparing for the end of year 1. So while this figure is good, all it will do for me mainly now is to help me calculate my equity option. So my equity option, the equity option will be equal to my face value. So your total liability or face value of that liability. Let me call it face value instead, so that it doesn't cause confusion with the not net present value, with the present value of the liability. So will be my face value minus my present value of liability let me also call that non-current liability in year 0. So that will be equal to 50,000 minus 45. What's that? I can't see well. 950, Abi. Oh, okay. I've already done it. Control. Okay, I'll just write it somewhere. So let me carry this. Let me shift this a little bit forward. So let me put it there. So I can say that that is equal to, sorry, I don't put equal to again. That's 50,000 minus 45, 950. Okay, so I'd rather have this not here. So let me come and do, so it's equal to, where's my original 50? Didn't I write 50,000 somewhere? I don't have 50,000. Okay, I don't have 50,000 anywhere.
You don't have anyway.
Okay, so I
You
have to
don't
write
have.
it. Okay, so 50,000. But at least let me trace that figure so that someone will know where we got it from. So minus that figure. So still give the same thing, obviously. Okay, so I have my equity option. So remain only small now. So once you've gotten your equity option, you now go and unwind your liability. So in this case, they've given you for only 1 year. So what you will now do is to unwind your liability for 1 year. So you will come again and say, you will have year, you will have opening.
Mr. Brian, are we doing it for just 1 year because of the question?
Yes, because of the question, they asked you to get it at the end of the year. So if you wanted to, I'll show you some things. I'll just point them out to you. When we do it in another place, because we must do financial instrument the way you're quiet. So when we do it in another place, you will see what I'm talking about. There are some things I'm just pointing out to you that you must remember. Okay, so we have nominal at 5%. Then our effective at, that one was 8%, right?
Effective was 8.
Huh? Effective was 8%, right?
Yep.
Okay. So nominal was at 5, effective was at 8. And then after that, we have our closing. That's all. With that, we can do our work. So now we start with our year. So we have year 1. It's only year 1 we are looking for. So we don't need to continue. Maybe I'll just write the year 2 and year 3 and show you something. When we're doing something else, you'll see it. Or maybe when you're practicing this, you can practice it up to that point. So our opening liability now, our opening liability will be our opening. We got that already. The present value will be our opening. Now our nominal value is 5%. That's 5%. But your 5% will be on your face value. It must be on your face value. And that one will never change. It must be on the face value and it will never change. It will just be on the face value. So if you are doing for 3 years, then this figure will be 25 for those 3 years. It will not change. It will continue being 25. However, your effective, are you hearing me?
Yes.
Your effective will be on, your effective is on your, is on the opening balance. Your effective will be on the opening. It won't be on the face value. The nominal is on the face value. The effective is on the opening balance. So the effective will change, will be the figure on the opening balance. the nominal will just be constant on your face value. It is effective that will be changing over time. Do you get that? Ella, please, I need you at least.
Yes.
So our effective now will be equal to 8%
Of 45950.
of that opening, exactly. So that's that figure. And then please remember that your nominal, all your nominals will be subtracted. Your nominal is subtracted from in arriving, your nominal is subtracted in arriving at your value, at your closing, while your effective is added. Maybe when we discuss this thing later, I'll try and explain this to you. Now it means finally that your closing will be equal to everything before it. So your closing will be the sum of the opening minus nominal plus effective. That's your closing figure, and your closing figure is that figure there. That's the figure. Now, if you continue this process through, in year 3, you will get that 50,000. Do you understand what I'm saying? This figure started at 45,950. By the end of year 1, it was 47,120, some 126. By the end of year 2, it will be maybe 48 something. By the end of year 3, it will be 50. So the nominal will continue swelling, or your liability will continue swelling until it gets to the face value, until it gets to 50,000. I would have done it here, but I'm afraid that if I do it, it will come and mess things up and someone will not understand where I'm getting what I'm getting from. So with that, I've done it again. Everything you need to do is here. So the rest of it now is to know where everything is going to. So I can come and understand or write where my accounting entry is basically. So I'll just do my debit and credit again so that I'll remember where the different things will be going. Like I said, under exam condition, you don't need to show any debits and credits. So, but sometimes it will be useful for you to be able to see how the flow of things is. So first of all, I'll debit my finance cost, is that interest. So the interest is finance cost. That's profit or loss. So I debit profit or loss, finance cost. I don't think this is the first thing I wanted to write because that's towards the end. So there are a few things. My equity option, it's just 3 things that are moving from here. Okay, so finance cost. Now please remember that your finance cost is the effective interest. So is that effective that goes to finance cost? And then I will credit my non-current liability. And my non-current liability will be that closing figure. And then I'll also credit my equity option. So we're in a good place for us to come back and continue. So we'll continue for the last part of the class. We're almost done. All that is remaining is tax.